Chad Morganlander of Washington Crossing Advisors is overweight value, running the following. Focus on companies that have financial flexibility, that are reinvesting back into their business, growing, profitable and well capitalized. Those will outperform over the next several years. Don't fall in love with companies with low PEs and awful balance sheets. Chad joins us now. So Chad, for me at least, you just described big tech, but I imagine you're going to say you didn't. So walk me through it.
No, big tech has pristine balance sheets, and they were cheap at one point, but now their valuations are somewhat unsustainable. So we are favoring value companies. We're 2x weight the industrials relative to the S&P 500. We are looking for companies that have that level of quality and consistency, that have this tremendous earnings potential post-pandemic. So look at companies like General Dynamics, like transportation companies like Union Pacific and Canadian National. You could find companies that are trading at 12, 15 times enterprise to EBIT that are quite cheap and have sustainable growth rates.
Chad, do financials make it into your list?
No, they do not. The reasoning behind that is we prefer companies that have very little debt on their balance sheet. We are looking for companies that, in a credit dislocation, can do quite well and continue to have a level of security and stability. With financials, we would be underweight at this inflection point.
Because, Chad, I think what we've got to talk about is just a psychological element to all of this, that people fall in love with certain areas of this market, and when they see the valuations beaten up, they find it hard to step away and get to the areas of the market that are winning. Can you speak to that, Chad?
Well, experiencing the 90s and the late 90s, what happens is that you just continue to let your winners go, and also you start piling into them. Where you get into trouble is when you look at your expectations in the outer years that you'll have these unsustainable growth rates. We think that investors should start to pare back those type of trades and go into this because you have a very low bar in regard to jumping over. If you are able to show a consistent profitability on many of these sectors that have this type of quality to them, then you will outperform and with much less volatility. So another sector one should focus on is healthcare. You can find some really interesting names there from a Merck and a Pfizer or United Healthcare that are trading at 15 times enterprise value to EBIT and have this quality to them. So again, don't fall in love with stocks, with companies that are going to higher highs that have these crazy unsustainable multiples.